questions. So the first one is what the media likes to call our finfluencer related regulations. As you know, we have jurisdiction over entities that we regulate. We don't have jurisdiction over entities that do not come and register with us and are not part of our ecosystem. So the way that this works is that the entities which are regulated by us, they are now being mandated that they cannot associate with people who do one of two things, either of two things. One is if they are not registered investment advisors or research analysts and yet they are giving investment advice or research analysis, then that's a inappropriate activity. They're supposed to register with us. Since they're unregistered and they're still doing it, so they're breaking the law. So obviously our regulated entities cannot have any association with them because they're breaking the law. The second is, irrespective of whether they are registered or unregistered, if they are making claims on performance or in terms of portfolio performance, their service performance, etc., unless it is specifically provided for them to be able to give that information of performance, if they are making claims without that approval, then again they are breaking the law, and therefore again our regulated entities cannot associate with them. So the basic principle here is what you cannot do directly, right? You cannot break the law directly. You cannot do indirectly by associating with people who break the securities law. Right? So that's the thinking behind this. Now, naturally, there is, there needed to be certain provisos and certain carve-outs that we needed because as part of our public consultation, we received a lot of feedback. And as you know, we take the feedback very, very seriously. So a couple of things which we have done is that if there are people who are exclusively engaged in investor education, but what that means is directly or indirectly they cannot be playing the role of investment advisor or research analyst. And of course they cannot be making any claims of return. So you cannot say I'm doing education but I'm claiming that my students make 5 crores a year. So somebody who is doing pure education, not giving specific securities advice and not making any claims of performance, such people are outside the purview of our regulations, so our intermediaries and other people can freely associate with educational institutions and people who are doing that. The second is that there are some platforms, and we have had very constructive discussion over the last many months with some of these platforms, where they have demonstrated to us that they have the capability both on a proactive basis and on a curative basis to address the issue of people who are breaking the securities law. So if there are unregistered people who are putting content on their platform, or if there are people who are making claims about performance and these are all illegal activities, then they have the ability, and they've demonstrated that ability, to be able to proactively deal with such people and also curatively deal with such people. Then such platforms SEBI can specify or notify, and then what will happen is that our intermediaries and other regulated entities can freely associate with people through such platforms without any fear of breaking our laws, because we are notifying that yes, the platform has mechanisms, and therefore even if, let us assume on a random basis, some random case slips through, which is otherwise illegal, the intermediary will not be held accountable because we have notified that platform as people who are taking adequate measures to prevent wrongdoing, right? So this is the first proposal, and of course the responsibility of ensuring that they don't deal with people who are doing illegal work will be on the regulated entities, because those are the ones that come under us. The second area that the board approved today was in respect of the voluntary delisting. We had discussion on this some time ago, And we had mentioned to you that the board had asked us for some data, which we presented to them. And therefore now this matter has also been approved today. And there are numerous elements of ease of doing business here. The first is that the fixed price process as an alternative to the reverse book building process will be permitted. Here the requirement is that the minimum price which has been determined as the floor price under the delisting regulations, over and above that a minimum of 15% premium will need to be offered if the promoter wishes to go for a fixed price process. So this is an additional flexibility over and above the reverse book building process. The second is that we had seen that there were difficulties for investment holding companies to be able to delist because of the holding company discount and other related matters. So we have now facilitated that through a scheme of arrangement, they can do selective capital reduction. And what this will mean really is that they will be able to pass on the benefit of the encashment of their holdings to the extent that they are holding liquid shares, listed shares, to their investors. And the requirement is that at least 75% of such companies, their fair value, should be directly in listed companies, right? So not every company can declare that I'm an investment company, provided that 70% of their fair value lies in listed companies, then they can avail of this. So this is the second flexibility, a new route for delisting which has been provided. In all of this, if the investment company is regulated by another regulator, naturally they would need to comply with the requirements of that regulator as well. The third flexibility that is being given is we are making the counter offer mechanism in a delisting process much more flexible. Earlier, the threshold for making a counter offer was 90% subscription. We have reduced that to 75%, provided that at least 50% of the public shareholding has been tendered. Okay? So this is the third flexibility. Of course, needless to say, the delisting process will succeed only if finally the acquirer reaches 90%. So the final vote still lies in the hands of the investor, whether they want this new acquirer to reach that threshold or not. The fourth area was the introduction of adjusted book value as an additional parameter for determining the floor price. So earlier, the book value was only a parameter that we reckoned for illiquid scrips. We are now introducing that for liquid scrips as well. When I say liquid, I mean frequently traded. However, there has been a carve-out which has been done for public sector undertakings. The reason for that being that very often the public sector undertakings have certain assets, particularly land, building and other things, which are not freely transferable. And therefore, while their value in their books may be X, these properties are not freely transferable, and therefore it would be inappropriate to put that as a minimum value for the valuation. The third thing is that this is more operational, but the reference date for computing the floor price has been changed from the existing requirement of the date of board approval to the date of initial public announcement. The whole logic being that this is the date when it gets crystallized, and we want the undisturbed price to form the basis. The next proposal is an ease of doing business, and you would have seen that we have a number of proposals which went to the board today on ease of doing business, and the reason for that is that we had, as many of you might recollect, we had created 16 different working groups for different stakeholders of the capital market ecosystem, with the mandate and the terms of reference that tell us what is it that you would like from the perspective of ease of doing business. So many of those working groups have come back to us now, many of them with interim reports, some of them with final reports. So you should expect to see a whole stream of proposals which are really reflecting, SEBI coming forward to do that ease of doing business for multiple stakeholders. So the first big set of such proposals went to our board today, and so you will see that reflected in the next few proposals that I'm going to talk of. The first is we had an additional disclosure framework for FPIs. This was in August 23 circular that we brought. This was in the context of concentrated holdings in a single group or very large FPIs, and we required them to make additional disclosures. There were various exemptions given. So we are adding one more to that list of exemptions, which is university funds and university-related endowments, which meet certain criteria. The next ease of doing business is in terms of the issue and listing of non-convertible securities, so basically debt securities, bond issuances. Here the whole thing was being driven by a desire to be able to put money into the hands of the issuer as soon as possible. So to streamline the process, because we've had so much automation in our market ecosystem and in the payment system in the country, that there is no need for us to continue to have timelines which are outdated. So in order to facilitate that, numerous things have been done. Simple things like the period for seeking public comments. So if the issuer is already an equity listed company who makes regular disclosures in any case, then there is no requirement for the debt issuance to be open for documents for public comments for 7 working days. So minimizing that. Reducing the minimum subscription period from 3 working days to 2 working days. And as we did in the listing of IPOs, where we moved the time for listing from T+6 to T+3, which has worked exceedingly well. There have been no problems at all. The ecosystem has really responded well. So this is now going to be an optional facility available to the market for a period of 1 year. So you can still choose to go with a T+6, or you can choose to go with a T+3. For a period of 1 year, this will be optional. After that, the T+3 will become mandatory. Also, some other, smaller reforms like, reducing the bulkiness of issue documents and saving on advertisement costs, so allowing window advertisements for issuers containing a QR code or a link so that people can see the full advertisement there. And lastly, as part of this entire T+6 to T+3, which is on the lines of equity IPO processes, similar to that, therefore, for investments up to 5 lakhs which are being made through intermediaries, the UPI will then be the mandatory process because all other processes require manual intervention and delays. So in order to avoid that, we are streamlining this on exactly the same lines as equity IPOs. The next one is also related to ease of doing business for debt issuances. Again, minor things but important to the issuers. So for instance, the promoters. Right now, the document requires their PAN number and personal address to be kept in the offer document. Now, clearly this is a privacy issue. And therefore, this will now be deleted and only kept with the exchanges as a matter of record. A couple of other smaller things to align timelines, etc. Largely operational, but with a focus on ease of doing business. The next one, again, is for ease of doing business in the area of REITs and InvITs. A number of small proposals, largely going by the fact that the timelines the industry needs flexibility in timelines for doing various things. And if the investors are okay with it, for instance, minimum notice period for meetings, etc., there should be no reason why the regulation should stipulate anything more. Also, we are providing for an e-voting option and an option to attend meetings through the electronic mode to all the unit holders for all unit holder meetings. So we believe that, COVID times taught us this, gave us this opportunity to learn, and therefore we should carry it forward. And so REITs and InvITs will now mandatorily be required to provide an e-presence and an e-voting option. Also, you've heard us say this before, that the REITs and InvITs now are at a certain stage of maturity, disclosure and governance that the regulator feels comfortable with. And therefore, with all the risk management measures which are in place for these instruments, we now believe that dropping the trading lot to 25 lakhs would not be inappropriate. And we are comfortable with these are obviously not retail investors, but high net worth investors coming in and at this reduced amount as compared to earlier, which was 1 crore? 1 crore. Also, given, as I said, the automation in the entire ecosystem, we have revised the timelines for payment of distribution to the investors for their payouts to 5 working days from the record date. This is compared to 15 days from the declaration of dividend, etc. So this is again a efficiency and optimization process which will benefit the investors. Next one is in respect of AIFs. We have two proposals which got approved by the board today. The first is, again, ease of doing business, where in the past it was not clear to the industry that they were permitted to borrow short-term funds in order to meet shortfalls when they call for the money from their investors. So we are making it explicit that yes, we have no problem with that, but along with the guardrails that are necessary. So for instance, ensuring that if one of the investors out of 20 has not honored the call for funds and they are needing to borrow in order to make the investment, then the interest cost of that borrowing must be borne by the investor who has not paid. It cannot be borne by all the other investors as part of the scheme. So that is a safeguard for them, and also to ensure that investors have a level playing field and different drawdown schedules are not offered through leverage routinely. There is to be a cooling off period of 30 days between every 30-day borrowing. And also this is to be exercised only as a last resort. It cannot be routinely used in order to give preferential treatment to certain investors. So the industry was quite pleased with this proposal because, as I said, they didn't know that our regulatory intent was to permit it, so they were quite happy to hear this. In terms of large value funds, we have seen that there was a risk that some of these large value funds had the risk of becoming permanent capital vehicles, which becomes a problem on account of numerous things. First of all, the investor doesn't have clarity on his investment horizon. Then there are delayed disclosures and recognition of bad assets. Liquidity becomes a problem because if the fund is continuously extended, then the investor has no exit option. And also the performance of the fund managers is not reflected correctly. So in order to take care of this, now a cap is being specified of 5 years. In terms of the funds which are already in the market today, we have found a very elegant solution to deal with it. So we basically said that you need to align with the new rules within 3 months, but you have the flexibility in modifying your base tenure. And so, for instance, if you had said 7 years plus 7 years, right? Base is 7, extension is 7, but now you can't do 7 as the extension, you can only do 5. So now you'll say 9 plus 5. So you're still okay, right? You have the right to do that so that none of the existing funds are put to any inconvenience. But going forward, over and above your base tenure, you can extend only by 5 years. Then we go on to another very interesting proposal related to investment advisors and research analysts. We are facilitating what we call a safe space for investors to be able to differentiate between regulated and unregulated entities. This is a purely optional mechanism for the registered entities. It's not mandatory. But what it will give is an ability to an investment advisor to differentiate himself or herself from unregistered entities, because the payment mechanism that through which the investor is expected to pay the fees for investment advice will be only a couple of designated entities who will facilitate this safe space. So if the investor is paying through that safe space, he knows that he is dealing with a registered entity, and he knows that the payment channel through which he is paying is a safe payment channel. So we believe that this will over time get traction, because the trust in the system will improve, and that the good players in the market who are registered good intermediaries, they will use it as a differentiator and advise their investors to really come through this route, because then they can get a lot of comfort that they're dealing with the right set of people. The next proposal is related really to the market infrastructure institutions, doesn't directly impact the investors, but this is basically a set of criteria, basic criteria on the basis of which the market infrastructure institutions will be assessed by external evaluators once in 3 years, and every year internally by themselves. The purpose here really is that a recognition of the fact that market infra institutions are not like any other normal company or listed company. They play 3 very different roles. The first is the provision of what is practically public infrastructure. It is in private hands. These are private entities, often listed, but it serves the purpose of being like a public infrastructure. So there's a huge responsibility to ensure that it functions like a public infrastructure. The second is that they are first-level regulators, so they must perform the role of being first-level regulators. And the third, of course, is that they are expected to be running an efficient business in a nice, efficient, cost-effective way with a lot of innovation. So all of these 3 aspects of how we expect a market infrastructure institution to be run is captured in this framework. And with the suitable weightages being given to all of these factors, so that no one aspect of the functioning of an MII skews the way in which they function. The next proposal is cybersecurity and cyber resilience framework, which has now been will be notified by SEBI for all its regulated entities. The 2 important aspects of this: number 1, we have taken a risk-based approach, or a graded approach as we call it. We have defined 5 categories of regulated entities based on their span of operations, number of clients, trading volume, asset under management. So basically, what is the impact of this entity were there to be a cyber attack or a technology resilience problem in them? So these 5 categories are, of course, the MIIs are right on top. The qualified entities, like qualified brokers, we have qualified stockbrokers, we have qualified RTAs. So they come into the second category. Mid-size, small-size, and self-certified regulated entities. Now, the second interesting aspect of this is, and this was based on market feedback to our consultation paper, where we talked about data localization. The industry has requested us to do a data classification and localization. So the regulatory data must reside within our shores so that the regulator has instant access to it. However, certain types of data, which we consulted with our high-powered advisory committee on cybersecurity, some of that data we are now calling more like IT data, and that we are giving a dispensation that it can be offshore, because many people have cybersecurity monitoring globally rather than locally. So we felt that it was perhaps suitable to do that. But certain guardrails have been put in place. For instance, within 48 hours, the data has to be brought on shore, etc., etc. The last part, which is not here, but this was actually implemented some time ago. It was not made mandatory. Now for a certain category it is being made mandatory, the smaller entities, which is that there is a market SOC, SOC being the Security Operations Center. So as we know that smaller entities find it very hard because this stuff is expensive. Cyber security protection is expensive. So we were not wanting our smaller regulated entities to be disadvantaged, and therefore we created a concept of cooperative and collaborative cyber security creation. So there will be at least 2 entities in the market ecosystem that will offer this market securities operations center, and the small entities can simply hook up to them and get that protection. It's a base level of protection, and the cost is very, very reasonable. So let's say that a small broker has only 5 nodes in his system, in his office, for which he needs protection. So that will only be in the region of 50 to 70,000 rupees per annum. And if we, see more and more traction, and if this cost can be brought down further, that would be even better. But the objective is that our market participants, in order to be able to protect the data of their investors, and in order to ensure that they are up and running and not susceptible to cyber attacks, the protection that they need should be available in an affordable fashion. So the market SOC is really going to play that role. Another item which is not here in this sheet but I'd like to share is again related to our market infrastructure institutions. We have right now a concept called financial disincentive, which is meant to trigger whenever there is a technology lapse or a technology disruption amongst the market infrastructure institutions. It was an automatic financial disincentive. Earlier, it was designed to trigger on both the institution as well as the key personnel, the CEO, the CTO, etc. It's been some time since that was initiated, and on review, it was felt that while the financial disincentive should remain on the institutions, on the individuals, it should not be an automatic penalty because the role of the individual. See, for the institution, it's a yes-no answer. Was there a lapse? Was there a failure? Yes, no. But when it comes to an individual, a certain amount of judgment has to be applied as to whether that person had really done his job and had done everything in his power to make sure that, the systems stay up and running, or was there an error of omission, commission, whatever it was. So judgment needs to be applied, and therefore we will not have an automatic disincentive system on them. So that will fall off now. Of course, if there is really some egregious action or inaction which has happened, then SEBI is always within its rights to take other action. But this automatic application of financial disincentive will no longer operate. Lastly, the annual report of SEBI, which is placed before the Parliament, was also approved by the board for placing before the Parliament. And This is not. It's not part of it. Okay, sorry. One more aspect which has been hotly discussed in the media is on the entry and exit of scrips in the FNO segment. So the board today approved the new criteria.
It's not in the press.
We will give you a copy. We'll give you a copy. So, Muru, can you get this photocopy?
They have extra copies.
Not the top part, just the text. Just the text.
Could you finish the sentence? New criteria for
Suspense.
For F&O stocks.
We'll live with the
Okay, for FNO stocks. So first in terms of the regulatory thinking behind it, and then the specific criteria, how they are changed, we're going to give you the details. So that's what will be on that sheet. But first the regulatory thinking. The regulatory thinking is in 2 parts. The first is that in order to ensure that there is a healthy linkage between the cash market and the F&O market. Many years ago, we had brought in a regulation that there will be physical delivery of open positions on expiry. Right? That was the first step we had taken in that direction. The second step that we are taking in that direction is now today to say that the criteria of which stocks will be permitted in the F&O basis the criteria of how their shares behave in the cash segment. We need to adjust those parameters because they were, in 2018, they were set in 2018, and obviously in the last 6 years, the market has grown and the whole volume has grown, size has grown, everything has grown. So those parameters which we had set 6 years ago are no longer appropriate. So in line with the way in which the market volumes and value has grown, we have changed those parameters in terms of eligibility to enter the F&O stocks. We'll give you the specifics very shortly. The second thing that we are doing is to introduce or extend the concept of product success framework. So as you know, in our indices, we have a product success framework, which means that the exchanges can introduce a new index for F&O trading. But if volumes do not pick up and it is not a success, then after a certain period, it has to be withdrawn. Why is this? Why is it that we have this rule? Is because we know that if there is a contract available in the market which has very thin volumes, it is very, very vulnerable to manipulation. The amount of money you need to manipulate an illiquid contract is very, very small. So therefore, it was imperative that that same protection which we have given on the indices side should also be given on the stock-specific F&O. So we have extended the concept of product success framework to stock-specific F&O as well. So if the trading doesn't reach a certain minimum level, which means the trading is too thin, it is very vulnerable to manipulation and therefore it will need to exit. But this exit will only be after a minimum period of 6 months. So for 6 months, the question is whether the volumes are picking up or not. So there is a glide path to implementation of all of this. You will see that in the details that we will circulate to you. And so with these two changes, there will be some differences. There will be some stocks that will go out of the list and some which will come into the list. You see, we can only backtest based on the past data. But obviously, these will come into effect only later. So I think we would not like to do that because then it's speculation as to whether those are going to stay or go or come, because nobody is going out today or tomorrow. We're going to wait for that 3 month, 6 month period and watch the underlying and watch the F&O volume, and only then will there be an entry or exit.
Based on volume hasn't changed. Based on today, how many stocks may be eligible? And if the volume hasn't changed in the last 2 years, 3 years.
I've been advised by Mr. Anant Narayan that it would be inappropriate for us to talk about that.
Does it remain at the same level?
Let me put it this way. The total number of stocks actually goes up by a handful.
So if we do the back testing,
Goes up by about 5 or 6.
if we do a back testing as of now, it's 182 currently. It goes up a little bit marginally. There are some which exit, some that come in. It's not a very large number that goes in and goes out. But the caveat we want to emphasize is we don't know. It's as of today. So the PSF, as Chairperson just mentioned, becomes applicable only 6 months from now. So we can't apply today's criteria we don't know what it will be 6 months from now. Likewise, for the existing stock, the 182 stocks, we're not going to apply the exit criteria right away.
Yeah.
We'll give them 3 months.
3 months.
Before that starts to kick in. But as things stand, if you do a back testing today, it goes up marginally, reflecting the fact that we've not done too many entries over the last few quarters.
And would it be auto?
And there is an auto.
Exit
Yeah.
to kick in.
For existing.
Is there an auto route or do exchanges have to conduct the exercise, the one which they do?
It's the same process which is followed today, which is every month they do an exercise to back test and see whether there's fresh entry happening or exit that needs to happen. So the same criteria which will continue, no change on that.
No, process is same,
Process
criteria
same.
is
The
different.
criteria has been obviously marked up given that.
Post circular, right, sir?
I'm sorry?
3 months post you issue the circular.
That's right.
Yeah, circular will come quickly. So 3 months, so roughly you should expect that nobody is leaving in a hurry as per the new criteria for the first 3 months. And for this new, extending this concept of product success framework, nobody is leaving until 6 months.
By the way, just to add, this product success framework by itself will not cause too many exits.
Yeah,
As
it's a
things stand
handful.
right now, it's a complete handful. Of course, we can't speak as to what will happen 6 months from now. It's more like a safety system being put in place
For the future.
for the future to ensure that there is adequate liquidity in every single stock derivative.
Even for PSF, I mean, whatever the analysis you would have done, how many stocks you are finding?
Handful.
Really handful, as in
Is it as per the the discussion paper that came in? You mentioned products success.
Yes,
framework.
yes.
Have you changed that framework or is it?
There is one
we will
technical, yeah, been circulated. There was one technical correction we made because of the way that the market computes buy and sell volume. So should you count buy plus sell, or you should only count buy or only count sell? So for that, on account of that, we've made a change.
Can I read out the criteria, ma'am, very quickly?
Yeah.
So the criteria as far as the top 500 stocks in terms of average daily traded volume as well as market capitalization, that doesn't change. That's exactly identical as before. The median quarter sigma order size, which was 25 lakhs previously, is now 75 lakhs. The market-wide position limit now will stand at 1,500 crores. So again, in sync with the movement in the market cap since 2018. 1,500 crores. The average daily delivery value is now being put at 35 crores.
This has gone up from 10 crores.
That's gone up from 10 crores because the traded volume and the delivery volume has gone up by over 3 times between 2018.
1,500 for MWPS.
That's right. And 10 to 35 crores. Now the PSF conditions very quickly. The first one is identical to what you have on indices currently, which is 15% of trading members or 200 trading members, whichever is lower. That's identical to what you have on indices. Again, what is identical to indices? Trading on a minimum of 75% of the trading days during the review period. Average daily turnover of at least 75 crores during the review period. This is what Chairperson mentioned earlier in the discussion paper. We had mentioned 150 crores because we had taken two-sided volumes. Now we are taking one-sided volumes, and therefore this number is 75 crores. And average daily notional open interest of at least 500 crore. So these are the 4 criteria that we're putting up for PSF.
The applicability, as you said, that will be notified, and after that.
That's
Why
right.
have you taken a notional open interest and not the premium open interest? Because the maximum open interest comes in options.
So we'll come to that subsequently. As of now, we're not changing what we have in the PSF that we have for indices. We've kind of copy-pasted that into the single stocks as well. If there is a larger change to be done, that will be done separately in terms of the way we measure metrics, etc.
One thing you also said is that the net addition would be very small about that stocks, but is the churn very big?
Not very
Not
large.
very big, no.
Couple of dozen.
Yeah.
Couple of dozen or dozen?
Couple of dozen. As in 24, in the region of 24. 2 dozen, couple of dozen. You all worry too much.
So actually the number of stocks, just to reiterate, should go up based on today's backtesting.
Backtest.
Ma'am, one question away from all this. Another one is that the size of this part. We have mentioned that 2 entities will be offering market security operational centers. So, any suggestions on that or bids before how would that be done?
So right now what we are expecting is that the 2 exchanges are likely to do it.
And the fee collection will also for investment advisors will also be through exchanges or through SEBI?
No, the fee collection is a mechanism which, as you know, BSE is the administrative body for IAs and RAs. So it is planned that that will be certainly one of the entities that will be designated for that. Most likely the other set of people who have shown interest, and as you know, we generally prefer to avoid monopolies in any function, so we like at least 2 players in every function. So most likely the people who have shown interest and are almost natural entities to do that is the MF utility.
What do we mean by external evaluation of MIs? What exactly does it entail?
It means that there will be an agency, the exchanges and other depositories and everybody will send us 2 names of who they think are non-conflict entities who are capable of doing that assessment. They will send us a couple of names, we will select one, and based on the detailed parameters that have been laid out, and these have been laid out in consultation with the MIIs. So their industry standards forum, we have, as you know, a very good system of industry standards forum now. So their forum has sat together and designed this for themselves in consultation with SEBI. So we are also very comfortable with it. So it's a very detailed set of parameters where they will undergo an assessment every 3 years externally.
Now, for the delisting part, last time when it was discussed, you said that there was not enough data for the people. Have some reports or some findings from any of the companies come for delisting, is there any possible something more?
No, we shared additional data with the board today, on the basis of which this proposal was approved.
I have some questions on delisting, if I may ask. So specifically, could you offer an illustration on how this optional or alternative to reverse book building will work, and what kind of companies or?
It's available to everybody.
Right.
So anybody who says that I would rather go for the fixed price option, so basically the floor price is still computed as per the SEBI regulations. You add another 15% on top of that.
Yeah.
Above that number, you can come to the market and say that here is the offer that I am making and I want to delist. And if you reach the threshold of 90% with that fixed price offer, then you can go ahead.
That's exactly the question I in fact had.
Mm-hmm.
That, the threshold of 90% has not been easy to reach, even with high price bands in the reverse book building process. So, what kind of company is expecting to reach it with a 15% premium to current market share?
How did you arrive at 15% premium?
So that was one of the data sets that the board had asked us to look at, and we looked at that data and we looked at the past cases that have been there and what kind of premiums were there which were given at that time for the successful issuances, and basis that there was a decision made on this 15% premium.
Because the voting requirement doesn't change. Right?
The threshold doesn't change.
Correct. So I'm just curious, companies wanted a fixed price mechanism.
That's correct.
They said they were being held ransom by small groups of shareholders in the reverse book building process.
That's right.
And that being held ransom was that they would not approve. They were large enough in number to stall the delisting.
Right.
Because there would be 90% acceptance at a certain reasonable price.
Right.
So now, how is this going to work? If there are small groups of shareholders holding companies to ransom there, why would they agree to a 15% premium?
So the question is, I would break it up into two. First of all, this is based on what we have understood from our advisory committee as to what works for them, what doesn't work for them, and having to balance the fact that finally the decision should be with the shareholder. So that is the balance we have to strike. Our understanding from the market is that the process of reverse book building and the fact that it can be taken, that the final cutoff can be taken to stratospheric levels, is what is bothering them. And even there, by the way, as I said, we have made some liberalization so that they can offer a, what is it called? What price? Revised price, etc., at a much lower threshold of 75%, etc. So our understanding from the market is that this would be a useful tool, helpful to them. Exactly how they expect to overcome cornering of shares, we believe they know the market better than us.
And how do you arrive at fair value of the company from a shareholder's point of view? Of course, there is one section of the
Specific PIN codes are not basically given insurance. Specific occupations are not provided insurance. People who do not have educational qualifications undergraduate are not provided insurance. So in short, term insurance is a very elite product for a country like India. Right?
Okay.
If you look at the percentage of people, when you cut down all these cuts, like when you put all these cuts